Good morning and welcome to Stock Market. Today it's Thursday, June 20th, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email to follow along with this show, as well as get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities finished higher in Wednesday's trading following dovish comments from the latest FOMC meeting. It seems everybody kind of got what they wanted from the meeting yesterday. Fed was sufficiently dovish to drive equity prices towards all-time highs and send yields lower. Healthcare and bond proxies were the best performers. Materials, energy, and financials underperformed. Treasuries were stronger, and the curve steepened. The dollar was weaker versus the euro and the yen. Gold finished down 10 basis points, and WTI crude closed down 30 basis points. Breadth on the New York Stock Exchange was positive at 1.5 to 1, and on the NASDAQ was positive as well, 1.4 to 1. Again, your outperformers: healthcare, utilities, REITs, and tech. Underperformers: materials, energy, financials, and industrials. And as we get to the desk this morning, we have some follow-through with S&P futures up nearly 1% in pre-market trading. Asian equities were higher overnight, led by China. China tacked on nearly 2.5%. European markets are moving higher as well. Treasuries are stronger, with the 10-year yield testing 2%. The dollar is lower against the yen and the euro. Gold rallying up 2.5%, and WTI crude is up over 3% due to some global geopolitical concerns. As we step in now and look at the market, what are we doing? We're knocking on the door of all-time highs after those dovish Fed comments, and futures actually have us trading above that 29.50 level here this morning. Still resistance for the cash market, but it is being tested here this morning. Support moves up. It's now in the 28.50 to 28.75 zone, and the RSI continues to improve. We ticked at 64.55 on a closing basis yesterday. Chaikin money flow is bearish, so some mixed signals from the indicators, but price is king, and price is knocking on the door of all-time highs. You can kind of see here this steady consolidation was kind of interesting to me as we had a long gap between testing the highs, right? October till May, and now only about a month and a half later, we're testing them again. So it seems to me that the market wants to break out, and some of the breadth metrics that we're going to look at a little bit later in this show do confirm that. So in the market in a minute, what are we talking about? Stocks move higher on the heels of those dovish Fed comments. As I said, the 10-year yield is testing the 2% level. Looking at certain factors, quality has been outperforming. Breadth metrics continue to improve, and that's confirming recent price strength. As I said, we'll take a look at that a little bit later here in the show, and futures do point to a higher open here today. Taking a look at the power bars, we can see that the Dow added 9 basis points yesterday, 7-4 in favor of the bulls. S&P 500 tacks on 21 basis points, 137 bulls to 64 bears. The NASDAQ was an outperformer, nearing a 3-to-1 bull-to-bear ratio, 29-10. Small caps an outperformer as well, 491 bulls, 327 bears. Bonds upticked, sending yields lower. And according to the Chaikin Power Bar, large cap stocks and small cap stocks are bullish. Across the board, major indexes are mixed, but these four that we look at are all bullish for the most part. Taking a look now at our stock of the day, auto-generated by our algorithm based on the Chaikin Power Gauge rating. It's First Citizens. It's a bank stock, closed at $440.28, up 1.9% yesterday. So interesting that the bank stock actually had a nice outperformance on a day when yields moved lower. Chaikin Power Gauge rating for First Citizens is very bullish due to very attractive financial metrics, strong earnings performance, and strong price volume activity. Taking a look at the chart, though, what do we see here? Very bullish stock, strong trend, strong industry group, type of name we want to consider. And what I love about this is I haven't seen this stock before, so it's a potential new idea. It's one that I'm going to be adding to a bullish watch list, though. You can see here the rating recently turning very bullish. Been an outperformer, but that outperformance is waning. Stock is closer to overbought than to oversold. Chaikin money flow is, we'll call it neutral at best, neutral with a bearish bias, kind of hugging the long-term trend line here. For me, I'm going to add this one to a watch list, see if I can see if some of the other metrics that we look at start to improve before becoming, bullish on this name and looking at adding it as a potentially bullish idea. Really what I want to see is I want to see this relative strength start to tick back up, and I want to see money flow improve, and I want to see that in conjunction with an oversold rating. So ticker symbol FCNCA getting added to a bullish watch list here today. Diving in now to our sector tracker, looking at the movement of the major sectors over the last 5 days. Communications remains at the top of the list. Energy seeing a bit of a rebound here from oversold conditions, but the trends there still remain bearish. This looks like a bounce, a counter trend bounce within the context of a downtrend. Discretionary and real estate round out the top 4, and real estate is one of those bond proxies that should benefit as yields tick lower. Healthcare, tech, and industrials are middle of the road. Our bottom 4 are utilities, financial staples, and materials. Again, utilities are one of those bond proxies. Should rates break below 2%, we would expect utilities to do well. Financials, declining rates are likely a headwind for that group. Staples giving some back, and materials came under pressure yesterday. They are at the bottom of the list over the past 5 days. Turning now to our industry in focus, and this is an important one for me. The industry in focus today is semiconductor services, which over the past 6 months has outperformed the S&P 500 by 9.62%. However, its power bar ratio, which measures future potential, is slightly weak, 7 bears to 6 bulls, and it currently ranked number 14 of 21 subsectors that we look at. Now, the importance that I place on semiconductors is their relative strength, right? Market kind of bottomed out exactly 6 months ago, right around that Christmas Eve time frame. And look what's leading. So as semis have been leading, the market's been doing well. This relative performance of semiconductors is what I like to focus on. And with the power bar ratio mixed like this, we need to know what stocks to avoid to keep our portfolios out of trouble. And the stocks to avoid, CREE, C-R-E-E, has a very bearish rating. Max Linear, MXL, has a very bearish rating. And CEVA Inc., C-E-V-A, has a bearish rating. Now, as we look at the ETF here as a whole, semiconductor ETF, the SPDR S&P Semiconductor ETF, ticker symbol XSD, does have a bullish Chaikin Power Gauge ETF rating. And what's interesting is that you can see here, the strong outperformer to start the year, and the market did well, began to underperform, and the market kind of went into that little May swoon. But notice what's happening here. The intensity of underperformance is diminishing for the semiconductors. And as that intensity of underperformance has diminished, the market has started to do well. Bullish investors who see the market near all-time highs want to see this metric continue to improve and bust through and turn green. That would be really positive for the overall equity market, in my opinion. Now, for the fund itself, XSD is overbought with bearish money flow. It is above the rising long-term trend line. So the picture here is somewhat mixed, but really what I want investors to key on is the relative strength. To the extent that semis are outperforming the market, that's a bullish indicator for the market. And the flip side is also true. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. Some positive analyst company on comments on Allergan sent that stock higher by 6.23%. IQV, second day in a row of gains following their positive investor day. The earnings report sent Adobe higher by 5.21%. LW caught an upgrade, sending that stock higher by nearly 4%. And News Corp higher for a second day in a row as investors parse through their commentary and like what they're seeing about their strategic review. On the loser side of the board, Silicon Valley Bank, SIVB, as we said, the banks could be under pressure with rates falling. Didn't see anything company-specific to drive that stock lower by 3.2%. Albemarle, no real news. Stock trading down with the materials group, down 2.6% or nearly 2.6%. Schwab, down 2.5%, as were the other online brokers. Falling rates, a headwind to their business. Schwab down 2.5%. Mosaic, MOS, no real news there on the day. Sent that stock lower 2.5%. And RJF, Raymond James Financial, down 2.4% on the day. Getting into the charts now, taking a look at some of the comments that we're making in our note and some of the things that we want to highlight. We're looking here at TNX. This is the CBOE 10-year U.S. Treasury Yield Index. It's our proxy for 10-year yields, and you can see we are now testing that 2% level. Now, we've been unabashedly bullish on the treasuries, meaning we expected yields to go lower, and that theme has continued to play out. The trend is clearly down below the 50-day moving average, below the 200-day moving average, and the move is confirmed by momentum. Here is the RSI of the yields. Notice how it routinely has become oversold, but cannot come close to becoming overbought by the traditional metrics, where 30 is considered oversold and 70 is considered overbought. But it's important to know the characteristics of indicators that you use. And one of the characteristics of RSI is that in strong trends, those thresholds shift. So in a strong downtrend, we would expect TNX to routinely become oversold to the downside and not become overbought, right? In a strong uptrend, the reverse is true. We would expect it to routinely breach that 70 mark and never really give you a chance and get down to 30. And that's what we're seeing playing out here with TNX. Now, 2% is likely psychological support at the round number, but this trend is decidedly down. Looking at breadth metrics, on Thursdays, I dig into some of the breadth metrics that we look at to gauge the underlying strength of the S&P 500. Here's the advanced decline line. So the advanced decline line is just a cumulative line of the difference between advancing stocks and declining stocks on the day, and it's a running total. And what we can see here, and we highlighted this last week, is we had a breakout through all-time highs for this metric that has continued. So what we would expect is for the S&P 500 to follow suit. That's what we said last week. And now the S&P 500 is, in fact, knocking on the door of all-time highs. So as the market moves higher, we want to see this indicator continue to move higher. If the market was making all-time highs and this indicator was going lower, that would be a negative divergence, and that would give us pause. One of the other breadth metrics that we're looking at is the percentage of stocks in the index above their 200-day moving average. And you can see here it's moved over to 68%. So a healthy majority of stocks in the S&P 500 are now trading above their respective 200-day moving averages. So that's a longer-term measure of trend. However, we've seen improvements on the short-term metrics as well. If we look at the percentage of stocks above their 50-day moving averages, it went to 61% from 51% last week. And likewise, on a much shorter time frame, the percentage of stocks above their respective 20-day moving averages ticked up to 85% from 72% last week. But what's interesting to me is I ran a quick test, and what I said was, tell me what the forward 6 months return looked like for the S&P 500 when more than 65% of their stocks are above their 200-day moving average, and the index is above its 200-day moving average. And you can see, based on data going back to 2010, 86% of the time we're higher 6 months later for a median return of 6.16%. So breadth metrics continue to be bullish for the overall equity market. That's the type of confirmation that we want to see as the market is knocking on the doors of all-time highs. Again, if these metrics were heading lower, that would be a potential warning sign. And now just kind of looking at one of the factors that I look at, quality is on the verge of new highs. This is the SPHQ, the Invesco S&P 500 quality ETF. And you can see here, knocking on the doors of new all-time highs, likely going to tick above here today. And again, momentum is interesting. Notice that as it consolidated, as this fund consolidated, it never became oversold. It got close, but never got there. And now the ratio is moving higher, or the RSI rather, is moving higher once again. And on a relative basis, you can see that SPHQ broke out, kind of tested the breakout level, and is now moving higher once again. So for you ETF investors, this might be one that you want to consider. Take a look at SPHQ. That's going to wrap it for today. Head over to chaikinanalytics.com/today to sign up for that email. You'll be able to follow along with this show on a daily basis. I pull a lot of the content for this show from that email. Have a great day, everyone. I'll see you tomorrow.